Hello and welcome. Have you ever just stopped and wondered what your life is actually going to look like when you finally stop working? And more importantly, how to make sure you're truly ready for it? Well, today we're going to tackle that exact financial puzzle, how to make sure your retirement savings last. By the time we're done here, I promise you'll have a much clearer picture. So let's get into it. Really, it all boils down to this one single question. You need your money to grow, right? Especially for a retirement that could easily last 30 years or even more. But at the same time, you've got to protect it. This balancing act, it's the absolute key to a successful retirement. We're going to explore some key strategies today. And hey, if you want to create a plan that's tailored just for you, you can find some really helpful tools over at retirementaihelper.com. So let's be clear, this isn't about choosing between growth and safety. Not at all. It's about finding the perfect blend of both that works for you. Think of it like you're fine-tuning your car's engine for a really long road trip ahead. Growth is basically your portfolio's accelerator. It's the power you need to outpace inflation and fuel a long, comfortable life. Safety, on the other hand, well, that's your brakes. It's there to preserve the money you've already built up and to give you stability when the markets inevitably get a little rocky. To get where you're going securely, you absolutely need both. Okay, so how do we actually build this well-tuned vehicle? We do it by using a few key financial tools. Let's take a look at the main building blocks that every investor has at their disposal. In your toolkit, you've really got four main players: stocks, bonds, REITs, and cash. And each one has a very different job to do. Stocks, they're your growth engine. Bonds are your stabilizers. REITs, which are real estate investment trusts, let you invest in properties without actually buying the buildings yourself, which adds some nice diversification. And cash, well, cash is your safety net for any immediate needs or emergencies. And you can really see their different roles in action on this chart. If you look at history, stocks have delivered average annual returns of around 10%. That's why they're such a powerful engine for growth. Bonds, with returns closer to 5%, they don't offer the same high-flying potential, but they do offer more stability. They act as that crucial shock absorber when markets get bumpy. All right, now I want to talk about a hidden risk that honestly a lot of people don't see coming until it's way too late. It turns out that your average return over, say, 30 years, it really doesn't tell the whole story. The timing of those returns is absolutely critical, especially right when you hang it up and retire. It's called sequence of return risk. And in simple terms, it's the danger that if you run into a bad market downturn right after you stop working, it can do some serious long-term damage to your portfolio. Why? Because you're forced to sell your investments when their prices are low just to pay your bills. And that can cripple your savings for years and years to come. Let me show you a really powerful example. Let's imagine we have two retirees. We'll call them A and B. They both start with $1 million, and they both plan to withdraw $50,000 a year. The only difference is their luck. Retiree A gets hit with a nasty bear market right out of the gate. And the result is just dramatic. Because of those early losses, retiree A had to sell off way more of their assets at low prices just to cover expenses. That permanently damaged their portfolio's ability to bounce back. Meanwhile, retiree B, who got lucky with some early growth, built a cushion that made all the difference for their long-term security. So here's the crucial point. That first decade of retirement is a uniquely vulnerable time. Managing your portfolio to protect yourself against a bad sequence of returns is honestly one of the most important things you can possibly do. Okay, I know that risk sounds scary, but here's the good news. We understand it. And because we understand it, there are proven, solid strategies for building a more resilient portfolio to defend against it. For anyone who prefers a simple kind of set-it-and-forget-it approach, target date funds are a fantastic option. They are specifically designed to automatically reduce your risk over time. As you get closer to your target retirement year, the fund itself shifts more of your money from growth stocks into more stable bonds. This automated glide path is built specifically to deal with that sequence risk for you. Now, another really popular method is the bucket strategy. It's just a simple but brilliant way to organize your money and your mindset. You create 3 different buckets. Bucket 1 is for your immediate needs, about 1 to 2 years of living expenses in something super safe, like cash. Bucket 2 is for the medium term, holding maybe 3 to 10 years of expenses in stable bonds. And Bucket 3 holds everything else, invested in stocks for long-term growth. That way, if the market tanks, you just draw from your cash and bond buckets. You leave your stocks completely alone, giving them the time they need to recover without you being forced to sell at the absolute worst possible moment. So both of those are fantastic strategies, but they lead us to the most important point of all.
The ultimate goal here is to find the balance that is perfect for your life. There is no magic one-size-fits-all portfolio out there.
Your ideal mix of stocks and bonds is deeply personal. It really depends on your own comfort with market swings, whether you have other income sources like a pension or Social Security, and what your long-term goals are for your family or for charity. All of these factors have to be considered when you're building a plan that actually lets you sleep at night. Now, for decades, the 60-40 portfolio, that's 60% stocks and 40% bonds, has been a classic balanced approach. It's not a hard and fast rule, of course, but it's a time-tested starting point that has historically given a really good mix of growth and stability. You can think of it as a solid benchmark to compare your own personalized plan against.
So as we start to wrap up, let's just reflect on this for a second. Retirement isn't just about reaching a certain age, it's about reaching a state of financial readiness. It's about having a resilient plan and a thoughtfully built portfolio that can support the life you truly want to live, no matter what the market decides to do in those critical first few years.
You have worked so hard for your freedom. Now it's time to plan for it with that same care and attention. If you want to explore these ideas a bit more and start building a roadmap that's all your own, retirementaihelper.com is a really great place to start. Thanks so much for joining me.